Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are comparing the top 4 companies that have either actually done a reverse stock split or they are about to perform a reverse stock split. So the 4 stocks and companies that we are going to be talking about today are Amazon, Alphabet, Tesla, and Shopify. In this video, we will be going over what these companies do, the latest stock news, and what a stock split could do for these particular companies, because in general, a forward stock split is relatively good news among investors. Now, this doesn't change anything fundamentally about the company or the company's market cap. It just increases the number of shares that these companies have, which then lowers each individual stock price. And in general, the investment community looks at these forward stock splits as very positive, while the majority of investors find a reverse stock split has a more negative connotation. So if you didn't know, Amazon, ticker symbol AMZN, is an e-commerce giant. Alphabet, ticker symbol GOOGL, is an internet search giant. Tesla is an electric vehicle manufacturer, and they also do plenty of other things. And then lastly, we're going to talk about Shopify, ticker symbol SHOP, and they operate a cloud-based e-commerce platform. So we're going to start off with Amazon. Should you start buying more AMZN shares for Amazon? Well, if you didn't know, Amazon's AMZN stock trades for $109 per share, and they recently went through a stock split that was a 20-for-1 stock split that occurred and actually was executed on June 6th. However, many investors think that the company is somewhat undervalued right now, because even the critics of this company think it's worth somewhere around $107, while the more bullish positive analysts as well as investors think that the company could surge all the way up to $232 in the next 12 months. However, with many economists thinking that the United States is going to enter into a recession, how good is Amazon in a receding economy? Well, honestly, it's going to impact them very negatively, like the majority of stocks on the stock market, and this is going to expose Amazon's price to cash flow ratio, which is going to stick out like a sore thumb in a declining market, which would be very bad for Amazon. But the good news is that Amazon is a large cap company and that they are relatively safe. They are one of the safer investments in my personal opinion. And according to a report that came out in March of 2022 by eMarketer, they estimate that Amazon will actually account for around 40% of all online US spending this year. And that is absolutely insane. So clearly, they have a huge grasp on this particular market. Also, why I am bullish on Amazon personally and why I own a lot of AMZN stock is that I really like their AWS or their Amazon Web Services. And AWS is so powerful that it actually accounts for around a third of the global cloud infrastructure spending during the first quarter at least. So AWS is literally Amazon's golden ticket, and that's why I personally love this company. Now let's move on and talk about Alphabet, which is a parent company to both Google and YouTube. Alphabet's GOOGL share price is $2,190 per share. However, many stock professionals think that Alphabet is trading at somewhat of a discount right now, because at minimum, investors think that the company should be trading at $2,506 per share, while at the maximum, they think that the company should be worth around $4,533 over the next year, and that is absolutely phenomenal. And if you remember, they actually announced plans for a 20-for-1 stock split back in February. However, Google's stock split didn't take place until July 15th. Just like the other stocks on the market, the threat of a near-term recession is Alphabet's biggest problem right here, because it's going to destabilize its core business, which is right now their revenue that they get from advertising. Their ad revenue is the thing that gives them the most money, because they are literally the largest search engine in the entire world. And with a recession coming, this is going to disincentivize other companies to run ads on Google, because not many people are going to be buying things or wanting to see ads in a recessionary economy. So even for a great mega cap company like Alphabet, a recession is still going to negatively impact them. But just like Amazon, I would say this is one of the more safer stocks to buy, and I also love this company as well. According to Global Stats, they show that Google specifically has control of around 91% of the entire worldwide internet search share, which is crazy. Clearly, that is a huge monopoly over the internet search market. Also, Alphabet is a parent company to YouTube, which has become the second most visited social media site and search engine in the entire world. And YouTube also generates them a large amount of ad revenue. Lastly, similar to Amazon, Google has a cloud platform, which is the number 3 ranked global cloud infrastructure services provider, which is absolutely phenomenal. And to me, Google Cloud is going to be their leading operating cash flow driver for this company well into the future. So this is a very solid company. The next company we're going to quickly analyze, and then we're going to compare and contrast these companies, is Tesla's TSLA stock, which currently trades for $697 per share. However, according to analysts, Tesla is undervalued right now because according to the most bearish negative analysts, the company should at least be worth around $893 per share, while on the higher end, the company could explode up to $1,620, which would more than double the current stock price, which is absolutely phenomenal. Tesla is a clear leader and, in my opinion, is the number 1 leader that's undisputed in the electric vehicle space. I also made a very old video that predicted that Tesla will be performing a stock split, and I actually made this video after Tesla just did a reverse stock split, which was a 5-for-1 forward stock split in August of 2020. However, recently, my prediction came through to fruition because they have announced another 3-for-1 stock split that shareholders are going to vote on whether or not to give authority to Tesla's management to perform a stock split in an upcoming meeting on August 4th of 2022. And of course, I think it's going to go through and they will end up splitting the stock, which is exactly what my prediction video said would happen. But the negative side to Tesla is twofold. So the first one is the Elon Musk Twitter situation. If you don't know what's happening there, I have videos on that as well. Basically, Elon Musk was going to buy Twitter. Twitter wasn't really sure about it, and then Elon Musk threatened to back out, and now Twitter wants him to buy it, so they're suing him, and apparently this is going to all go to court. However, that story is still developing, and it could take multiple turns. On the other hand, Tesla's current stock price is trading at an absolutely insane PE ratio, which is actually pretty bad, and we will talk more about that later in the video, but I do want to highlight 2 more positives. So the first one is that Tesla has done something that no other automaker has done, and that is to literally build a company from the ground up and now has entered mass production where they are extremely competitive. And in my personal opinion, Tesla's technology paired with their manufacturing capacity due to their gigafactories is their number 1 competitive advantage, and few electric vehicle manufacturers can compete with Tesla in that particular regard. Then lastly, we're going to talk about Shopify's SHOP stock, which trades at $30.50. However, investors think that the company should be trading anywhere between $38 and $100 per share. However, recently, if you look on the stock graph right here, you can see that the company has cooled off extremely radically over the past couple of months. And in my opinion, this is going to be more of a long-term play, and I do think that the price is going to continuously fall, especially if we enter into a full-on recession. So out of these top 4 hyper-popular stocks that are all eventually either have done or will do a forward stock split. So it all comes down to which are the best companies to buy right now. So I would say the biggest concern for Shopify, similar to Amazon, is going to be their ability to scale during a recessionary economic environment. Shopify individually is counting on small business growth, but in a recessionary environment, there is not going to be much small business growth, and to me, it's taking on too much risk by investing into this particular company that is heavily exposed to small business growth. So if small business growth flattens, it's going to expose Shopify's already very lofty valuation and multiple, which is going to cause the stock price to crash. Their overall addressable market is $153 billion, but the company already trades at around a $41 billion market cap, so clearly they've already acquired a lot of that market, but right now their multiples, valuation, revenue, and earnings need to catch up to those particular valuations. Now, what is good about Shopify is that they did launch their own buy now, pay later service, which is going to be great. It's called Shop Pay. However, I don't think when we compare them to the other companies on this list that they hold their own. So now we just have Tesla, Amazon, and Google. So when we look at Tesla, Tesla has a big problem in the sense of their price to earnings ratio, which is currently around 96. And if we compare that to other automakers on the market right now, we see that they are trading at price to earnings ratios that are in the single digits. So clearly, Tesla is not competitive in a very recessionary environment when people stop buying these cars. This is clearly a growth stock, so when things are going great, Tesla is absolutely exploding. But when things are going very poorly, Tesla is going to drop and not hold their value as well as the other two companies on this list. So now we've eliminated Shopify and we've eliminated Tesla, but we still have Amazon and Alphabet. So out of these top heavy hitters that are relatively safe blue chip stock investments, in my opinion, which one is better? I would say that Alphabet is the better buy here because it stands out as a smarter stock to buy. Because even if Alphabet's advertising business gets hit very hard due to a recession, the company's historical inexpensive valuation, lower multiples, and overall resiliency in times of uncertainty and stock market drops, they tend to hold their value better than Amazon, which is why I think this company is not only safer, but it also provides great upside opportunity paired with the safety of their downside buffer. So if you are looking for a safe stock that is a blue chip company that has great upside potential that also performed a stock split, then Alphabet out of these companies is going to be my top pick. But all of these companies are honestly pretty good investments depending on your risk tolerance and your investing style. So with that being said, I would love to hear your thoughts down below. Remember to go and smash that like button right now, subscribe if you are new, and I'll see you in the next YT video.